Well, great to have the opportunity to provide this update. My name's Thom. I'm the lead manager of the Aberdeen New Dawn Investment Trust based in Singapore. The objective of the trust remains unchanged, and that's long-term capital appreciation through investing in the Asia-Pacific ex-Japan region. And we apply our long-term quality investment philosophy and process and build the portfolio from the bottom up, trying to identify the best quality ideas across the region. And at the moment, the trust has about a quarter of its exposure to Greater China. That's more like a third, in fact, if you were to include Hong Kong and Macau. So 25% or so in China itself, and another 10 or so percent in Hong Kong, Macau. We've are pretty positive on India and the long-term opportunities there and the quality of the companies we're finding there. And so that's about 15-16% of the portfolio. We're a little lighter elsewhere in North Asia, so in the markets like Taiwan and South Korea. But have some significant exposure to the technology sector in those markets, and specifically sort of semiconductors. And then we have a reasonable allocation or position in Southeast Asia across markets like Singapore, Vietnam, the Philippines, and then Australia, which is a slightly differentiated position for this trust versus others in the peer group. We have about 13-14% of the portfolio invested there, and that is predominantly in the resources and mining sector, oil and gas sector, as well as healthcare, with Australia home to some world-beating medical devices companies. So this year, as you'll be well aware, has been a more challenging period for markets globally, and Asia's no exception. So we're seeing negative returns for the start of the year, but over the 6-month period, the trust, this is 6 months to end of April, is still delivering positive returns, up 6-7% in terms of net asset value. That's trailing the broader Asian market by a few percentage points, and that really reflects stock selection within China, with China being a relatively difficult market to navigate in recent months. If you recall, we've had the dramatic U-turn on the sort of COVID policy, with China reopening in unexpected fashion in October, November time last year. That prompted a wave of new COVID infections, and that weighed on sort of economic activity and mobility, so pretty subdued economic performance towards the end of last year. But then great excitement that this big reopening was going to drive a revival in consumption and spending, and so the market then rallied quite sharply in the early part of this year. So it's been a pretty volatile market, and we've just struggled to navigate that in the short term. Looking sort of through to the rest of the year, we're still positive that this reopening tailwind will play through, and that consumption in particular will pick up in China. And so we've been positioning around that and expecting some of those holdings and stocks to drive better performance into the latter part of the year. So I think that the main area that we've been focused on over the last kind of 6 months or so has been on the China positioning. That's where we've seen the greatest kind of change from an economic and market standpoint. As I mentioned, that dramatic kind of U-turn on the COVID-19 policy and the reopening of the economy, rolling back of all of those restrictions. So we have been selectively adding to holdings in China, particularly in kind of the domestic consumption sectors, but also in the healthcare sector. These are companies and areas of the economy that tend to also be relatively more insulated from the geopolitical headwinds, which remain ever present, sadly, when it comes to China and the US. So China's been a big focus. We have, and as I said, added a little bit in recent months there. I think the other area where we have been focusing is on the tech hardware sector. And that's predominantly our holdings in South Korea and Taiwan, although we also have a holding in a Netherlands listed company, ASML, which we consider merits a place in the portfolio because it generates more than 3/4 of its revenues from Asia. And there we feel that the cycle in the semiconductor sector is beginning to bottom out, and that we will see a recovery going into the latter part of this year and into early next year. So we're just keen to position around that as we expect that recovery to drive outperformance in shares of some of these companies. So the first holding I would highlight is OCBC Bank, or Overseas Chinese Bank. It's one of Singapore's top 3 banks and has an impeccable track record of managing its credit cycle through the cycle with extremely low, consistently low non-performing loan levels. It's got a bulletproof balance sheet. It's extremely well capitalized, but it's also, and all of these factors kind of protect you on the downside, and that's important as you kind of find yourselves in current times facing a lot of uncertainty in the global economy. But it's also a bank that's well positioned for long-term growth. So they have a core business in Singapore, which is a relatively mature and an exciting market, a small market as well. But they have significant positions also in Indonesia, which is a market that has the same population as the US and will drive long-term growth for them. And they are very strongly positioned also in Greater China, across Hong Kong, Macau, and the mainland. So those are the kind of long-term drivers for the banking business. They've also got a highly successful private banking and wealth management business, which has been growing very rapidly, and as well as an insurance business. So multiple kind of arms or legs to its growth. And as I say, it's been a very prudently managed bank through the cycle and over the years. And so in a sense is the very essence of a sort of high quality business and stock, and it's one as a result that we've owned in the New Dawn portfolio for 20 plus years, and it continues to be a core holding and one that's attractively valued and pays a good dividend yield as well. So that's OCBC. The second name I would highlight is a different kind of stock. It's more of a growth stock. It's called Shenzhen Mindray. It is a China A-share stock, and is one of several A-share names that we have in the portfolio. It is one of China's largest medical devices companies, with strengths in patient monitoring systems, diagnostic testing systems, and imaging systems like ultrasounds. They've got a market-leading position in China itself, and are benefiting from China's desire and efforts to kind of localize and move away from American products in particular, but international and multinational products more generally. So that's a tailwind for them, reflecting the geopolitical environment. But they've also been making or having significant success in growing overseas. Even in the US, despite the geopolitics, they delivered 30+% growth there last quarter. So I think healthcare is somewhat immune from those geopolitical tensions, given their sort of life-critical systems. They've grown strongly in the EU as well, and also in other emerging markets. And looking forward, whilst it's certainly a quality stock, I'd describe it more as a sort of quality growth stock, and you have to pay up for that in terms of the multiple, but they expect to deliver with some confidence 20% top line and bottom line growth for the next 5 to 7 years, given the deeper penetration into these markets and the entry into new verticals and new segments with new products, whilst generating a return on equity of over 30% on a net cash balance sheet. So again, another a great example of a sort of quality stock in China that we think merits a place in New Dawn's portfolio. In terms of the outlook for Asian markets and indeed markets globally, clearly there is a lot of concern and plenty to worry about in terms of rising recession risk in the US and the West more generally, what's going on in the banking sector in the US and Europe, and generally slowing growth and sort of rising concerns around potential slowdown for the global economy. I think Asia, in that context, it won't be immune. Clearly, this is still a globalized global world economy, and Asia very much connected into that particularly through exports. However, it also still has these domestic growth engines, and I think the China reopening story, although it's not come through as quickly as the market was expecting, we still believe that it will come through. There's tremendous pent-up savings in China that we think will convert into spending as consumer confidence gradually comes back, and that will provide somewhat of an offset for China, with growth recovering there, but also for the rest of the region as well, given how interconnected the rest of Asia is with China. So I think in that respect, we still expect to see growth in Asia, and recession is less probable. We generally see corporates in pretty good health still. I talked about OCBC as an example, stock with a very strong balance sheet. And very low non-performing loan levels. Now, that may pick up a bit, and we will see a bit of stress, I think, emerge in Asia. But broadly, the balance sheets in corporate Asia are in good shape, and that will provide a lot of resilience. And there are still areas of strong growth, and I think India is one of those, and that in part explains why we have a particularly large weight in that market. We're still seeing quite good growth there. So overall, I think Asia feels to me as though it is going to be better positioned to battle and deal with the headwinds that the global economy is throwing at it. And quite a lot of this, from a valuation perspective, is already priced in, with valuations trading below their sort of long-term 10-year averages. So that again provides a degree of sort of downside protection and buffer as we look to the second half of this year and into 2024.